One of the things that I've noticed from watching financial markets for over 30 years is that there are two things that we can do when we see other people making mistakes in their investing. Either we can copy them and then follow their mistakes, which I've often found is actually the most likely tendency, or we can profit from other people's mistakes. We can see what they're doing and use that to enhance our own portfolio performance. So clearly, the main lesson for us is to find out how do we profit from other people's mistakes rather than throwing money away by copying them. This video is all about learning how to do just that. Now, clearly it's really important. What I want to do is share with you a quote from Warren Buffett, a very famous investor, just to give you a sense of how important he feels this issue is. Look at market fluctuations as your friend rather than your enemy. Look at market fluctuations as your friend rather than your enemy. Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. So to profit from Warren Buffett's advice, what I want to do is look at two separate aspects of how the markets trade. Firstly, what are these mistakes and how do they get made? And secondly, how can I make money from them? Now, my view, having watched the markets for so long, is that they're often a balance of two separate human emotions. On one hand, you have fear, and on the other hand, you have greed. Now, it's the balance of these two emotions, fear and greed, which determines whether we're in a bull market, where clearly greed is predominant, or whether we're in a bear market when it's fear which is driving the market down. Now, the extent of that imbalance between the two really matters, because if you have a huge imbalance in favour of greed, then the market can rally way beyond any sense of what its true value should be. And the same applies to individual stocks as well. Similarly, when fear predominates, the market can sell off and it can get so carried away, it can overshoot whilst it's selling off and become quite undervalued. So what we can look at now is to try and understand where these two emotions come from. Now, ultimately, fear and greed are driven by a number of different factors. What I want to do in this presentation is just highlight what 6 of those factors might be. I think it's really important that these factors are something you know and understand, and you can identify them very, very clearly in the market. So let's deal with the first one, fear of underperforming. For many investors, their performance is scrutinised either by their employer or by separate third-party consultants, and they will typically have their performance analysed on a quarterly basis. Some, it might even be more frequent, on a monthly basis, and of course for people who are day traders, they'll be looking at their performance on a daily basis. Now, the problem many of them face is if the market is going against them and they've had a bad quarter, as the quarter spins itself out, they simply don't want to lose any more money. And as a result, they may be tempted to just cut their positions and say, I've lost enough this quarter, I don't want to lose any more. That's the fear of underperformance. Maybe there's the sense that if they lose more than 5% any quarter, they might get fired. And as a result, when they've lost that much, they just cover their positions. It's a very natural emotion, but it doesn't mean they're necessarily making the best decision. It just means risk aversion suddenly kicks in. We can all understand that in our own personalities. If we made a number of decisions, they've gone wrong, there's such a temptation to cut the position. Now, of course, sometimes the reverse emotion kicks in. That you've made a decision, you bought some stock, it's down 10%, you still believe the stock is going to go higher, so you just buy even more. In other words, you buy more as the market is going down because your average cost is going to fall. That might sometimes be the right thing to do, but you've really got to think carefully, is this just my emotion taking over, or is this a scientifically valid analysis that I've done to determine whether I should buy that stock? Now, another emotion which takes over is fear of missing out. One good example of this is the rental property market. People see that their friends have bought properties at sensible low prices, they've let them out, and they're making good money in the buy-to-let market. They think they should have a go as well. If their friends are doing it, it's working for them, they want to play too. The problem is that the favourable market conditions, which may have induced their friends to play in that market, may not be as favourable now. But one of the big factors which is driving them is that they've heard other people doing it, and if lots of other people are doing it, then maybe it's the right thing to do. The fact that other people are doing something does not make it right. One has to look at one's own analysis and say, based upon the current pricing, is this the right thing to do? So I think fear of missing out really drives people to often buy or sell assets because that's what their friends are doing and they respect their friends. It's a very natural human emotion. Sometimes, of course, this leads to social pressures as well. If other people have bought something, to operate in that social milieu, maybe you feel as though that you need to buy it as well. So, for example, if all your friends have bought second properties they want to let out, you might feel as though socially you want to be a landlord as well and you want to buy. Or if all your friends are talking about the equity market because they bought equity a year ago and the market has rallied, you feel as though you want to be part of that discussion, so you buy equity too. But the equity market may be a lot more expensive at that point and maybe not as attractive for you to buy in. But nevertheless, people will follow social conventions, social pressure, and they'll do what their friends are doing, but not necessarily at the same time. Another mistake, and I think we've all made this one, is you get emotionally attached to a position you've got. Sometimes you've bought a stock, it's performed very well, and you're thinking, I'm just going to hang on to that stock because that's a good stock. You're sort of emotionally attached to it, and you don't reassess its value on a regular basis. So sometimes because of this notion that that stock has performed well for me, I will keep on owning it. Or sometimes we've all felt this, a particular market, whenever I've got involved in it, I've lost money. That's not a good market for me, and therefore I'm not going to buy it. It might be cheap, I'm still not going to buy it because that market doesn't work for me. These emotional attachments just don't make sense. If a market is not working for you, maybe that's because you don't understand it and you need to research it more before you buy it or sell it. Similarly, if a stock is working for you and it's always going up, maybe you understand that industry better, or maybe you've just been lucky. So being emotionally attached to a stock or a market and feel because it's gone up for the past in me, I should keep on owning it, is not a good idea. Another thing that we all fall victim to is we often exaggerate our own competence. We think we're cleverer than we are. You've bought a stock, you bought it cheap, it went up to fair value, then it became expensive, but you thought, I was so smart because I bought it. I'll keep on owning it, it's the right stock for me, but also I must have some innate intelligence because I realised that stock was cheap, and therefore you kind of don't want to sell it because you don't realise actually you've got to do more research and understand whether that stock really makes sense to own even after the rally has taken place. So just because you made a good trade on that stock 3 months ago or 6 months ago doesn't mean your insights about it right now are necessarily as good as you might think they are. So never overestimate your own capabilities at stock picking. Always go back to thinking, I've got to do my own research and my own research on a regular basis. Just because I got it right 3 months ago doesn't mean I'm going to get it right now. So these are just some of the mistakes that people make which lead to momentum existing in the market. Now there's two important takeaways here. The first one is try and avoid making those mistakes yourself. The second is that because of that momentum, the market can become overstretched and you can profit from this. That means if it's the end of a bull market, it's far too expensive. And yet people have kept buying even though the market's expensive. And if it's the end of a bear market, it means the market is too cheap, but people have been selling into a very cheap market. That's what we mean by overstretched. So now we know what an overstretched market is, we move on to the second part of the presentation, which is what do I need to know to profit from an overstretched market? In other words, where other people's mistakes have made the market very cheap or very expensive. So here are the 3 things you need to know to get this done. The first one is to know whether we're in a bull market or a bear market. The second one is to know how to identify an asset as being cheap or expensive. And the third one is to recognize that different investors are driven by different parameters, and therefore markets can trade cheap or expensive for some prolonged period. So this is what a bull market looks like. As you can see, bull markets don't go in straight lines, and nor do bear markets. It goes up and down and up and down. But the characteristics that you see, which are so important, is that you see a series of higher cyclical highs and a series of higher cyclical lows. So each time the market corrects down again in the bull market, it doesn't reach its previous low. It only goes part way back down, and then it goes up again and it reaches a new high. So that's one of the key hallmarks of a bull market. Now, of course, a bear market looks like something like that in reverse. Another thing you can watch out for to identify a bull market is watch the news very carefully. If a piece of news comes out that should drive the market lower and the market goes up, that tells me you're often in a bull market. In other words, a market which goes up on bad news really is definitely one which is going to go up anyway. Similarly, a market which is going down on good news is very often skewed towards a bear market. So look at how the market reacts to news. If its reaction is very symmetric, going up on good news and down on bad news, doesn't tell you anything. But if it keeps going up on bad news, you're in a bull phase. So what this is telling you, the graph of a market's behaviour in relation to the valuation of the individual stocks or the individual bonds is going to look something like this. So you can see that the bull market is triggered off by some catalyst when the market is cheap, and that's a great time to buy. But the momentum of the greed keeps on driving it higher, and it enters the next phase where actually it's quite reasonably valued, and it's quite fair to buy it based upon the attractive momentum. But the greed continues and it goes even higher, and eventually the market gets expensive, and there are people out there who are still buying an expensive market. So you need to know whether the pricing of the market is fair or not. And this means do your research. Have a look at the various valuation metrics there are. So in the case of the stock market, you have price earnings ratios, forward price earnings ratios, price book ratios, price sales ratios. There's any number of metrics out there. In the case of bond markets, you'll have to look much more closely at the underlying macroeconomic fundamentals to figure out, are the current level of yields reasonable or not? And of course, if it's property or classic cars, you'll have to look at the fundamentals that drive those markets. But certainly don't avoid doing your research. Now, I've said you need to understand the macroeconomy, you need to understand the stocks you might be buying, the bonds you might be buying, but there's one other piece of research to do as well. It's useful to understand who the other investors in the market are, because this will help you realize whether you're in a bull or a bear market, but also why they are buying and when they might stop buying. One thing that retail investors often don't appreciate is that professional investors may be investing for pension funds, they may be investing for insurance funds, they might be investing on behalf of retail investors, some of whom may be retired and want a relatively elevated level of income. Others might be young, working, and just want growth. The key point here is that different investors have different preferences, and therefore a bull market may be expiring for some investors who no longer see it as good value, whereas others who might be looking for growth instead of income might still be sucked in to continue purchasing. So when you're looking at the news wires, or when you're watching the news television, try and get an understanding of who is buying and why they're buying. Because if you see some investors start to pull away from the market, it's an indication that a bull market trend could be coming to an end. So there are two important takeaways that I really want you to understand from this video. Takeaway number one, you can really profit when people get carried away on the upside and the market just rallies too far. Momentum has pulled it up and valuations are simply too high, they're overstretched. Why is that important for you? So often you have stuff in your portfolio that you want to sell and you're looking for a good time to sell it. That's the time to clear out your portfolio. If there are things you really don't want to own, you think they're either misvalued or you don't want to hold them on 1, 2 or 3 of you, when the market's overstretched, that's the time to start selling them. The second takeaway is when you get a bear market, when the market has sold off too far to the downside, and markets do this really quickly sometimes. If you've got cash to invest, that's the time to invest it. Because often you're going to be buying stuff which is at a level that may be below fair value. So that's always a great opportunity. So recognize, therefore, when a bear market is coming to an end, people's momentum has got carried away, it's driven the market too low, and that's what you want to buy. So those are two clear ways that you can profit from other people's folly just by knowing when there is good valuation in the market. There's one other thing I want to highlight as well. Bear markets are very swift. And when the market tumbles like that, it becomes very dislocated. Now, what I mean by dislocated is that some stocks may fall 5%, others 10, others 15. People just sell in a panic. And it means often there are bargains to be had amongst those stocks which have fallen so rapidly and so far. So often, if I've seen the market fall very, very fast like that, what I'll do is try and pick around and see, are there any stocks which have been unfairly punished? Because it's those dislocated stocks which often represent good value to own during the next uptrend. So I hope you found this video really useful. If you have, please click like, please subscribe, as there'll be more videos coming along soon. And in the meantime, of course, enjoy your investing, and I hope it's profitable for you. Thank you for watching.